Hi everyone, this is Arpat from your YouTube channel Starpath Academy, and today just want to share a couple of thoughts about undervalued assets. My guess is I think in this current climate there's hard to find undervalued assets if you're looking with your traditional eyes, right? um, because everything has been pumped up with inflation. But so basically, what you're looking at is relative distances between stuff that has went up in value for a long term, short, um, basically a slow slope that was sort of general inflation, and then what you're looking for is what reflected the great money printing of the last 3 years immediately, and what still didn't catch up, with the knowledge that we are also in a depressionary environment. We're gonna be soon anyway. That's my opinion. Don't take that anywhere, but take it with a grain of salt. So, what are you looking for, right? What are the asset classes that you're looking for? And I think the basic stuff that you have to compare everything to is food, and it's food prices. So food prices are sort of tricky because of the supply chain interruptions and all of that thing happened. Then it has been a shock, right? But it has also been a slow and steady rise of food prices, right? And also from natural disasters and some other stuff that who knows why happened with all the fires, the food supply has also been disrupted. So normally that's what you would compare to in a hyperinflationary situation. Like, that's how I would measure it. How much compared to food prices this has gone up and that has gone up. And when you look at hyperinflationary scenarios, almost nothing, especially traditional asset classes, don't go up much as food prices. And that's pretty much what we have seen. Food price goes up 20% and house prices double, but then food prices go up another 20%, and then some food items already doubled, if not more, right? And now we're gonna be at the point, it's my opinion, that food prices will keep on rising at the same rate, but some asset classes, which are traditional asset classes like stocks, like bonds and houses, are no longer gonna be reflecting um, the same, I guess, basket that they used to, because almost nothing will continue rising as the same as food prices, right? So when you look at historical hyperinflationary scenarios, you're looking at, oh, the stock market went ballistic, right? Towards the tail end of hyperinflation. But if you look at how much bags of potatoes that bought you, that's probably halved. Or if in the sense, if something goes up 1,000% but still buys you half in potatoes what it used to, right? Nobody's really tracking how much the local market sells the potatoes for, but that means like the bigger and larger bill has already have to be printed back in the day to be able to afford that. So technically, your charts that you're seeing, your historical charts that amaze you, oh, look at this, how much this went up, it actually doesn't work jack crap, because food prices more than double outperformed what you're looking at a chart, right? So what do you have to do then, right? What are you doing then? How do you, I guess, invest in food? Well, that's why I've been telling you guys to try to grow your own food, or work out some deals with people who own land or farmers, and and that sort of people, because as long as you have that secure, then you don't have to sell assets that you think that are overappreciated, but technically you're still selling it half price compared to food, just to be able to afford something. So what we're looking at right now is still underappreciated assets that had, for some reason, they never catch up to this, but traditionally, or not traditionally, but there are hedges against major crises, right? And to be honest, of course, gold and silver. If you look at silver, it has been stuck for a while, right? And it's just been stuck. But if there's a big difference between the spot price and the price you can actually get it for at the store. So I think that's what we're gonna see it in continuation, that actually the spot price won't change that much for the next, I don't know how many months, but my guess is that the premiums will start going up and up and up to the point where the whole price structure is completely dislocated from reality, what you see in the news or what you see in newspapers. And that has been through basically sort of not necessarily a black market for it, but definitely a total price dislocation where you need to get to the street to know the actual price, right? And it has not been catching up because people are stretched, right? I think even JP Morgan or one of those big guys, banks, or is telling now, the savings that you guys had during the pandemic is now all but dried up. So now we're gonna see the pain kick in for many people, and that might mean there's gonna be some stuff on fire sale. So I'm pretty sure they won't necessarily be stacking up on silver and gold, right? So it's not gonna be an indication immediately. My actual guess is, and that's what I've seen, is that usually these precious metals have sort of a two-stage rise, right? One in an early stage where people who are too early get in, and they get in because they know the system is collapsing or will collapse in its current form. I'm not saying like apocalyptic, Mad Max scenario. Anyway, not yet, unless you're in Hawaii, I guess. But people pile in. They know, but they'll need to wait it out. So there's usually a bump, and that bump is sort of prices doubling, right? So people who do have savings or do have junk to sell, they're gonna pile into silver and gold, and that will be the first bump. And my guess is that will sort of double the price. Maybe a 50% rise in gold, and sort of close to 100% rise in silver, and that will die off. It will die off for a period until it hits the fan, and then everybody will pile in, and then it will have a second rise. So once it falls sort of back to the current level before the doubling, it stays there for a long time, in the sense then when the economic calamities happen, eventually more and more people are piling in to the point where there are lines and people are sort of just buying up everything, right? But at that point, it's like gonna be too late, because I think it's gonna be more pressure on supply, right? So that's my guess. Is I'm not giving time frames here, but I'm seeing that once this initial, so basically here's to lay it out. If my calculations are correct, I think some stuff are gonna be on sale in the next 6 months to a year, and prices of real estate and prices of other stuff might go down. I don't think it's gonna be that big of a crash that people think, but I think it's just, you know, volume and prices follow each other. So if volume grows and a lot of houses become available on the market, eventually people who really need to sell, so they will sell at a discount, and that's gonna come. But it's not gonna like house you all up. It's not gonna be that, oh, look at all these poor people who can now afford houses for pennies on the dollar, right? And it's not gonna be 2008 either, because if nothing else, the big companies will just gobble it up and rent it back to you, which we have seen that's a trend now. If anything, you may be, you know, they may kind of come up with this scheme where multiple people own funds in houses, and then you're kind of a micro investor, and you can just, that's already happening with art, and you're already happening with a bunch of stuff. So I think most likely that's how they're gonna suck your money into the real estate market, so it's somewhat gonna stay afloat. But anyway, I'm not here to talk about that. So basically what I'm seeing is the next 6 months to 8 months, I think that there will be a drop in prices and a deflationary scare will happen. And that's not going to be too good for precious metals. But after that is over, I think it will double from there. I don't know how long that will take, but I think a sort of double from there, and then the big pause, and then come, I don't know how many years, it will be again much higher. Because if you take a look at the 70s or something like that, and you look at, you know, these rises in silver and gold, that's what you see, you know. And those are not even like extraordinary times in the sense of, I mean, there were things happening, but it was not like global currencies crashing, right? So my guess is that the second rise will be sort of something to remember, you know. And if you take a look at the if you take a look at the 70s, precious metals way outperformed anything else. You know, you get like 40x rise or 20x rise on just the metals, right? And that was nothing special. So, but you have to be able to wait out these periods. So you have to have enough cash to be able to, you know, pay for your living. So I think first and foremost, have cash reserves before you get into the cycles. As long as you have that, you know, and as long as you have ways how you can produce food or get food right from the producers, or maybe even trade for food, your labor or anything else, then you'll be able to take advantage of these cycles. That's what I'm looking for. That's just how I think it's gonna play out. And I think we're gonna see a doubling soon, especially in silver, in the next 6 to 8 months. Unless, of course, something very big happens, which we'll talk about, I guess, next time. All right, but hopefully we don't get there. Talk to you next time. Bye.